Good morning, good afternoon, good evening, wherever you may be. This is Sid from Elliott Wave Plus, and this is the July 20 of 2023 edition of my quarterly premium plan webinar, where I explain all of the things that we do here at Elliott Wave Plus and show you some of my current analysis on a number of items and answer any questions or as many questions as I can during the hour here. About our service and questions maybe about Elliott wave counts or Hurst cycle analysis or sentiment or any of the other types of questions that might arise during the webinar. I'm going to turn off the video of myself so that it won't be distracting. And I'd like to show you first and foremost our website here at elliottwaveplus.com. That has Elliott has 2 L's and 2 T's, and I'd like to point you directly at our disclaimer. So for that, you scroll all the way to the bottom of any page at the site, click on the Terms of Service Disclaimer tab, and there it is. It's there all the time. If I were to summarize the disclaimer in one sentence, it would be, there's risk of loss in all trading. Before we get into some of the specifics about the market and about our service, I'm going to try to keep this to maybe 3, 4, 5 minutes here at the beginning of the webinar to show you the website and how to make your way around at the website. So this is the home page. This is elliottwaveplus.com. Now I am logged in as a premium plan subscriber. So I have a number of headings that show up here that wouldn't necessarily appear to you if you are a non-subscriber or if you are a subscriber to a plan, a lesser plan than our flagship plan, the premium plan. So you can see we have screenshots, webinars, nightly reports, 2 different kinds. And then we have our resources, educational videos, educational guides, and our blog. And then you can get in and look at your account and you can upgrade to the next plan up, or you can cancel whenever you wish. You can change your credit card on file, whatever. And by the way, we don't store the credit card information here. We have a credit card provider that stores all of that. And then the most important thing to remember about my site is at any page at the site, you must scroll down to see the entire page. So that our home page explains my history, and you can read about that. Explains the different tools that we use. So the reason I named my site Elliott Wave Plus is because we just don't use Elliott Wave here. We use a number of additional methodologies. And we have some momentum trade signals we provide for premium plan subscribers. Premium plan subscribers also get a nightly look at our sentiment, our proprietary sentiment screenshots on dozens of items. So they're completely aware of the how commercials are positioned versus retail positioning. We'll get into that. Intermarket correlations. We always look at correlations, and correlations come and go in the markets. For instance, gold many times will move opposite the US dollar, but it doesn't do that 100% all the time, tick by tick. There are times when correlations break apart, and we want to be aware of when those unusual breaks of the typical correlations are underway. We also look at multi-time frame momentum signal or momentum indicator divergences. We use Hurst cycle analysis here extensively. And of course, we use Elliott Wave. And along with any Elliott Wave count, there's going to be an associated Fibonacci price targets to go with the count. if your wave count is incorrect, then your Fibonacci targets are going to be incorrect. And if you have if you don't have access to Similog charts and Fibonacci tools that use Similog math, your Fibonacci price targets are going to be different than mine. Also, the specific Fibonacci targets that you use may be different than the ones I have found to be most effective. So this is part of the learning process of being a member at Elliott Wave Plus, to learn how I use the Fibonacci tools, which ones I have found to be most likely after 30 years in this business. And then as you scroll on down, you can see that there's 4 different plans with Elliott Wave Plus. And you can learn more about those plans by clicking on Learn More. Now, when you click on Learn More, it takes you to a very long page. And it talks about our different tiers of service. It starts with the trend plan. Now, if you want Elliott Wave counts on more than just Bitcoin, you will not like the trend plan. You will need to move up to a higher tier. And so there's an explanation of what you see here, or what you will get in each plan. The basic plan, EWP ScreenShots. If you're interested in my Elliott Wave counts on lots and lots of different items, this would be the minimal plan you would want to go with, the basic plan. And you can always get to the pricing of all the plans by clicking on pricing. Pro plan, it's essentially the basic plan, which is lots of screenshots on Monday or Sundays and Wednesdays, plus a weekly webinar on Sundays where I explain. It takes about 2.5 hours to explain how I derived all and combined all of the different methodologies of analysis into what I find to be the most likely forward roadmap for the markets. And this is by far and away our most popular plan, the Pro plan. It's $100 a month. And then the premium plan is $200 a month. We'll look at the pricing in just a second. And each higher price plan includes everything in the lower price plans plus some additional stuff. This one adds our sentiment condition screenshots on dozens of items every night. Professional traders really take a very close look at sentiment constantly, as they should. And that's what's included here. Now, many times in the weekly webinars, I will show the sentiment, our proprietary sentiment screenshots on the most popular items as I work my way through the webinar and cover all the different things. But the only way to get those screenshots every night consistently on several dozen items is to go with the premium plan. The premium plan also includes automated momentum trade signals. So that's a big long page, and you have to scroll down to see it. And if you click on any of the pricing words that you see, it'll take you to this master page, elliottwaveplus.com/pricing. It shows our different tiers, how much they cost. If you've never subscribed before to any of the paid plans here at Elliott Wave Plus, send me an email. You can do that through the contact page at my site. At the bottom of any page, you can go contact us and you say, hey, Sid, I've never subscribed before. I would appreciate 50% off my first month. And then I will send you an email back after I check to make sure you've never subscribed before, and say, yeah, as soon as you subscribe, I'm going to refund 50% right back to you. Cancel anytime. So there's a good look at the webinar. And then if you are a basic plan subscriber or higher, you get screenshots, a huge set of screenshots of my analysis of many dozens of items, the most popular items and more, on Sundays and on Wednesdays. And I leave at least 2 years of history of these. You hit load more and you can keep going back and back and back. You can look at what I thought at the time on the screenshots. If you're a pro plan or higher, then you get also to see recordings of my webinars going back at least 2 years. You can hit load more and you can watch my webinars. Are typically about 2.5 hours long, where I cover everything and explain just about everything we do here in great detail. Nightly reports, the daily trend reports, that's the only thing that the $25 per month people get. They get access to the daily trend report. And the daily trend report is trend charts on, I don't know, about 18 items to see what the daily trend direction is on any particular item. Okay. And, but in addition, you get on cryptos, you get my Elliott Wave counts daily and weekly. On Bitcoin, and plus a number of automated trade signals. Like there's my Elliott Wave count on a daily chart of Bitcoin currently. And this is tonight's edition, the edition for July 20. I can tell you that my general outlook for Bitcoin is bearish. And so if you are a Bitcoin investor and you only use, let's say, Coinbase, which does not allow you to short Bitcoin, it only allows you to go long. I don't think you're going to get much use out of the trend plan, the $25 a month trend plan over the next few months. I think Bitcoin is going to be bearish all the way into the first quarter of next year. However, if you are a Bitcoin trader and you use the micro Bitcoin futures contract, which allows you to go long or short Bitcoin, then yes, and Bitcoin is the only thing you trade, then yes, you might get some benefit out of the $25 per month plan over the next little bit. But to be honest with you, I think you'd be disappointed with a $25 per month plan if you are a Bitcoin bull right now. Now that's going to change come the first quarter of next year, the way things look right now. But right now, you probably, especially if you do not have the ability through a futures contract to short Bitcoin, you're probably not going to like the $25 a month plan. You probably should consider the $70 per month basic plan instead, and look to potentially trade some other items. So, and then also under the nightly reports is the premium plan tab. And so if you are a premium plan subscriber, then you get to see our nightly algo report. A nightly algo report, there's two different things you get, folders you get with it. One is the nightly report. That consists of buy and sell signals based on momentum, not on Elliott Wave, momentum, and a master summary report that shows you with some color coding if there's any new signals that popped up overnight. For instance, we got a new buy signal on XLE tonight. We got a sell signal on GDX, the gold mining index, tonight. These are all based on momentum. We had an instruction to change to a trailing stop on a buy signal on Euro USD. So what's happening on Euro USD? The last signal was a buy signal, but now it's saying, whoa, we're detecting some loss of momentum, change the stop to trailing. Oh, and actually, this signal, we already got that changed the stop to trailing on the 18th, and now it's actually saying exit the long position on Euro based on momentum and go flat, is what that is saying. So you can see, and then also additionally here, you get to see what the current daily sentiment index read is on a number of different items. So for instance, on the ES contract, the S&P, 81% of retail traders are currently bullish. That's pretty bullish. So most retail traders are bullish. How that comes into play is when retail traders, well, traditionally at major tops in the market, retail traders are almost all bullish. They just think that this thing is going to keep going up forever. And almost the entire group of retail traders is completely and totally convinced. And so, for instance, on the ES contract back in mid-June, as I recall, don't hold me to this, but I think we got a 91 reading where 91% or 92 maybe of retail traders were bullish back in mid-June. Now, here we are in mid-July, and retail traders most recently reached a peak of maybe 88, even though the market was higher. That is called a divergence. And if any of you looked at my last public recording, I was talking about the daily sentiment index and how sentiment was indicating that we were at or very near a significant major top. We're going to delve into that further as the webinar goes on. So you get the DSI on a whole bunch of items. The NASDAQ DSI in mid-June was a 93, and then it never reached quite that high again here in mid-June or mid-July, and it's starting to make its way to the downside, only a 77 today. So you get these very important sentiment readings on as many items on the list as DSI is published for. Also, you get the current Elliott Wave count and the current Hurst cycle analysis. So that is the website. It's called ElliottWavePlus.com. That shows you all the different tiers of service, how to read about them, how to choose between them, the different costs, what you get to, what you see, get to see if you're a subscriber, as well as there's a lot of videos, guides, and also access directly to the blog. Another item that we let me show something here. Oh, I've hid my, hang on just a second. I'm going to pull that aside, and I'm going to find my YouTube channel. And I'd hidden my bookmarks, and I'm used to having those up there all the time. And so hang on just a second, and I will show you my bookmarks. Well, anyway. Hang on. Okay, that's an ad. And when we look at my YouTube channel, it's called Elliott Wave Plus. And you can look back at different recordings that I've made public here. And the recording of this current event will be there soon enough, maybe as early as tomorrow. But the most recent one was this one. It was a presentation I made for the Elliott Wave Hub. And I talked more extensively about my service, my current analysis and sentiment in this. And so I suggest you go there and look at that, time permitting. And before we start getting into now to specific analysis on specific charts and also more into how our automated signals work, I'd like to bring up just a few slides, and feel free to chime in on the chat if you wish. But these are just a few words that came to my mind as I was preparing in my mind for this webinar, what I would say. The first is perfection. How many of you out there desire perfection in your trading? Well, perfection means that you probably are able to call each and every peak and trough perfectly to the tick and trade it to the long side, to the short side. Does anyone actually believe that that's even possible? Of course not. There is absolutely no such thing as perfection. So if you're going to go out into the wide world of interweb and make a decision on who you are going to listen to and follow on what they project is going to happen next in the market, and give you the best information about what is most likely to occur next. How many of you like to find the hot hand? In other words, when let's say you get an email from someone or you read an article and they claim that they have been the most accurate of Elliott wave counters, or that they've called each of the last peaks and troughs perfectly over the last year or whatever it is. Well, there's some questions I think you should ask yourself about those sort of marketing claims. Number one is, if someone claims to be incredibly accurate when it comes to Elliott wave, there's only one way to really establish that. And that is if they will show you a list of each and every trade signal they've given recently, and at what exact price point and what day they decided to go, or they suggested going long or short. What was the size of the stop that they suggested at that time? Was that stop to be a trailing stop or just a fixed stop? And then when did they issue a signal to get out of that trade? At what exact price and on what exact day? And what you'll find is in the world of Elliott wave, nobody does that. Nobody. Because Elliott wave is, guess what? It's an imperfect science. At any given moment, there's 100 Elliott wave counts and there's 100 people defending their count. How many of those wave counts are going to end up being perfect and going to end up being correct over the long haul? Well, almost no one is going to show you that. Now, I attempt to, because as I showed you in my website, I show you 2 full years at least of my screenshots that I send to subscribers. I don't take them down. As a subscriber, you get to look back and see. And guess what you'll find? Nobody's perfect. I'm not perfect. Nobody's perfect. No one's system is perfect. So, yeah, somebody can claim they have the hot hand lately, but beware. I'm old enough to remember that when I first started getting interested in the stock market, I subscribed to Smart Money Magazine and Money Magazine, and I would turn over to the section because I'm a numbers guy, and I'd look at which ETFs or at the time it was mutual funds had made the highest percentage over the last 30 days, over the last year, and over the last 3 years or 5 years. And something I noticed is that those lists changed every edition. And it dawned on me after a while that the mutual funds that had been doing the worst, that had the worst record, were probably the better ones to choose than the ones that had the hot hand lately. So there's something called reversion to the mean, and I think I suspect that it's completely true that whatever method seems to be working great this month may not work next month, and I like to compare that to what the stock market does. The stock market only trends aggressively about 1/3 of the time, and 2/3 of the time it consolidates. 2/3 of the time, I'll say that again, 2/3 of the time, the market consolidates. In other words, it chops sideways. And anyone that's in a momentum algo, they're going to have to give back during that period some of their winnings in anticipation of the next trend. And then hopefully during the next trend, it's a strong enough trend that they can capture all their losses back and more. So, is there a holy grail? Is there a holy grail on in a market that trends 1/3 of the time and chops sideways in a very nasty, choppy, seemingly random fashion 2/3 of the time? Is there a holy grail? And the answer is absolutely, positively no. No, there is no holy grail. So what are we left with? We're left with odds. So what I do at Elliott Wave Plus is I look at a number of ways to look at the market. Certainly momentum, internal wave structures, as far as the Elliott Wave is concerned, Fibonacci targets, sentiment, divergences, they're all in there, correlations. And then I try to combine all those and try to figure out what are the odds, what is the most likely thing to occur next. Am I going to be perfect every time? No. Is anyone going to be perfect every time? Absolutely, positively, no. The reason is because the market is a wild animal. It doesn't run necessarily on fundamentals. It doesn't run necessarily on overbought or oversold. It doesn't, sometimes sentiment can be extreme during a trend for weeks and weeks and months at a time. And so this is what I try to do. I try to, in an honest fashion, show you what the odds are. Are you going to lose on some trades following my work? Yes. Yes. Are you going to win on some trades? Yes. Are the winners going to be bigger than the losers? That's as close to the Holy Grail as we can come. So you have to carefully measure the odds and then and only then act, realizing that imperfection is 100% likely. And so you just have to do the best you can do. This is something that my beautiful and very smart wife tells me all the time. It's like, all we can do is the best we could do. And so that being said, I'm going to end that little portion of the webinar, and we're going to get straight to the charts. First, I want to explain to you what I think is happening in a long-term chart. And you might think, well, what good is this? It's so long-term, it's 100 years worth of data. Well, I think it's still extremely important. And I've explained this in recent times, and I'm not going to go into quite as much detail, but up from the 1932 low, which I'm labeling as a super cycle wave 4 low, looking for a completed 5-wave up structure to complete a super cycle wave 5 and therefore a grand super cycle wave 3. So I have specific Fibonacci targets that I have found to be the most accurate on Similog charts. And on Similog charts, sometimes they are very touchy on getting them to show properly on the screen. And so I believe up from the 1932 low, we got a cycle degree 1, 2, 3, and 4 through the year 1974. So the first Fibonacci target is this one at 41,020, which, by the way, has not been hit yet on the Dow Jones Industrial Average. And that, if price went up to that level and stopped going up right there, that would mean that the distance traveled from the 1974 low to that high would cut the entire move up from the 1932 low to that high by the golden section. In other words, wave 5 would be equal to 1.618 times the net traveled of the beginning of the pattern through the end of the wave 4. The rest of the Fibonacci targets on this long-term chart are more conventional. Although I will say this move, this 5th wave up from the 1974 low has been extremely, extremely extended. So in an extended wave in the stock market, the most likely wave to be extended is wave 3. And you'll notice that there was a Fibonacci target right here by this dotted line right here, where wave 3 up from the 1974 low would be a 4.236 Fibonacci expansion of wave 1. So this is wave 1. Take that times 4.236, and on a Similog chart, add that to the top of wave 1, and that became the target, and it was really, really close to being perfect. As close to perfection as you're likely to see on a long-term chart like this. Then the pullback that occurred from 2000 to 2009 was an expanded flat, and it retraced almost exactly a Fibonacci 0.236 of the entirety of the 3rd wave in burgundy or primary degree. So that also was quite close to perfection, as after a highly extended 3rd wave, you wouldn't necessarily look for a super deep wave 4, something more on the shallow side. So typically at a wave 4, you might look for a retrace of 0.382, but it came very close to stopping going down at a 0.236. So now we're looking at a fifth wave up from the, not only from the 1974 low, but also from the 1932 low, a wave 5 of 5, if you will. And the internal subdivisions look pretty good. 1, 2, 1, 2, 3, 4, 3, expanded flat or possibly an expanding triangle for 4 down through the year 2020, March of 2020, and then looking for a fifth wave up. If, and what I found is that wave 5s very, very typically, most typically, the best target to set for a fifth wave in a standard non-overlapping impulse is where they are 0.618 times the net traveled of 1 through 3. So if you take this distance from the beginning of the pattern through the end of the wave 3, that was in March or approximately of 2018, take that times 0.618 and add that sum to the bottom of the wave 4, you get 43,652. Also, there's another target of 41,981, where wave 5 in burgundy or primary degree would be that same Fibonacci relationship, where wave 5 in burgundy would be 0.618 times the net travel to 1 through 3. So all three of those targets are pretty close together, and none of them have been hit yet on the Dow. So if we haven't hit that target zone yet, which is right here on this monthly chart, what's going on? Well, I've explained this many times in other webinars. I'm not going to take too much time because I want to show some shorter term charts. But I think the move up from the March of 2020 low was an ABC zigzag. The Fibonacci relationships between the C wave and the A wave are almost perfect on the Dow and the S&P for it to be a zigzag, not a 5-wave structure. But it it traveled almost, I would say, about 80% of the way toward that Fibonacci target zone. Well, that's perfect for a wave 1 of an ongoing and unfinished ending contract diagonal. So I believe that we're in wave 2 of the ending contracting diagonal, and that the next major move to the downside is going to be to the downside. It's going to be to the downside. So each leg of a diagonal is typically an ABC zigzag, or possibly a double zigzag or triple zigzag, something from the zigzag family. Also, each leg of a diagonal is typically deeply retraces the prior leg. And so far, and we'll move into a weekly chart, we've only seen about a 0.382 pullback of the move up from the 2020 low through the January of 2022 high. We've only seen about a 0.382 pullback. Well, typically, according to the Blue Book, the Proctor Blue Book, Frost and Proctor, each leg of a diagonal typically will retrace somewhere between 66% and 81%. That's this circle down here. So we've not retraced anywhere near that. Not even close. Oh, and I was very interested to see that today there was a new inversion on bonds, and I made this note on this chart for a long time that we started getting bond inversions, which suggested that at some point in the fairly near future, we were going to get a recession. So I know back in October of 2022, the 3-month and 10-year bond yields inverted, which meant that you would get paid a better return if you just locked your money in for 3 months as opposed to 10 years. That means that the bond market has lost confidence in loaning money for very long. Well, just today we got another inversion, and I can't remember. It was on television. I have to look at it. It was, I think it was the 10 and 2, 10-year and 2-year. The 2 years paying a higher return than the 10-year. Don't hold me to that. I just going from memory there. Also, from a Hurst cycle perspective, I think we probably had 3 18-month cycles. So we're in the third 18-month cycles starting at the March of 2020 low. And we're just past the midpoint of the third 18-month cycle within a 4.5-year cycle, the black line. That's Hurst. So yes, the market has managed to stay up here. But I've got to tell you, you go back all the way to the 2009 lows and been following Hurst cycles for quite some period of time. Look at this 18-month cycle right here. There was a 5-week crash of 38% down into a very large cycle trough, at least an 18-month cycle trough. And it only took 5 weeks for that final 38% crash at that point. So this was an example of the market staying up, and then puking down into a large cycle trough. And that very well could be what we're seeing here. This count would be invalidated with any kind of new all-time high. Jay, any kind of new all-time high. Because each leg of a zigzag is an each leg of a diagonal in Elliott Wave is a zigzag or something from the zigzag family. So if this was A and this is B, B cannot make a new extreme above the beginning of A. So now we move into the daily chart on Dow Jones Industrial Average. And there's something that a phenomenon that I think has been underway in the Dow Jones Industrial Average. So I've had this count for quite a long time, the nuts and bolts of this count, and that is from the October low of last year. That was the end of the first zigzag to the downside, a leading diagonal for A in green, then a 3-wave up for B, and then a 5-wave structure down for C. That would be wave A. And ever since then, A in pink, we've been in, and that's also possible that was a wave W, by the way. We've been in an ABC zigzag. Why would I think we were in an ABC zigzag? Well, because from that October low in the Dow, we got 5-wave up structure. Very, very clear. So, and not only that, if you use a typical, see if I can get this right. Target, use a typical target for the end of a 5th wave. And this is my favorite target for the end of a 5th wave in a non-overlapping standard impulse, where wave 5 would be equal to the net travel to 1 through 3 times 0.618 on a Similog chart. That target was right there. I'll turn it to orange so you can see it a little better. And I brought this to the attention of all my subscribers real time. That was my target for the end of the 5th wave up there. And it hit it just almost perfectly. 1, 2, 3, 4, 5. So that had to be wave A of an eventual zigzag. It's also possible that it would be a wave 1 of an eventual impulse. Okay, so let's examine that for a second. If this was a wave 1, then obviously this would be the end of a wave 2, about a 50% retrace. And then you would be in wave 3 to the upside. You'd be in wave 3 to the upside. If you go back on my screenshots, you'll see that's exactly what I was expecting. I was expecting that the market would go ahead and climb to new all-time highs by the time we got into, actually at the time, it needed to be at or near all-time highs, which is this line right here, by the time we got into mid-May. And so I'm showing you about where mid-May was. Well, it was obvious to me that it wasn't even close, especially in the Dow. It wasn't even close to showing me wave 3 type character out of this low. It did initially, but then it got real rough and choppy and sideways. So this movement that we've seen up in the Dow Jones Industrial Average from the mid-March low is not impulsive. It's choppy, it's overlapping. That is not wave 3 type stuff. This is what I've been telling subscribers. Yes, Hurst was suggesting we could see a top as early as mid-May. That's the reason I bothered to show you that slide thing from the beginning, because no single methodology is perfect all the time. But it was giving a really strong warning that if you didn't get wave 3 character, by the time you got to mid-May, that it probably wasn't a wave, it wasn't a wave 3. And at least in the Dow, at this juncture, I do have to say there's no way this is in a wave 3 higher and that it's just going to keep going higher. We're seeing extremes in all kinds of ways and measures on the stock market now that would suggest that we are at or very near an important peak now, not, going to keep screaming higher. And that's why I think that the timing of this webinar is pretty important. So I think this was might have been an ending diagonal. In other words, it's a 5-wave structure, but it's choppy and overlapping. And if this was a 5-wave diagonal, we now have a throwover. Now you might say, well, that's a heck of a throwover there, Sid. It's, surely you wouldn't get a throwover that big. But in a diagonal, wave 5, in a contracting diagonal, wave 5 must be shorter than wave 3. And so far it is. It's 166,000 ticks, and this move up here was 200,000 ticks. At what point, if it kept going higher, would it not be a diagonal? Well, it would be around 200K, somewhere around 35,688. So let's call it 35,700. So the market closed today at 35,225. So there's still room for 500 more Dow points to the upside before this diagonal idea falls apart. But that's okay, because I've got all kinds of other stuff saying that this is not going to continue higher unabated. And the most important of those is Hurst. Now, some of you that might have been following me this year or tried my service and was counting on Hurst remaining really, really accurate, which for the most part it was going back the last year, and it was really doing a great job of calling the peaks and troughs until about mid-May. And then when we got this shoot to the upside that made a new high in mid-June, that really left some egg on the face of Hurst cycle analysis, which is one of the tools I use. It's not the only tool I use. So I'm going to open up a Sentient Trader analysis. And I'm going to show you, and we're going to go back here. So the question is, was this March of 2020 low actually a large cycle trough, or could it possibly have been the December of 2018? Because this plunged to new low in March of 2020. Yeah, it made a new low below the late 2018 low in the Dow and in the S&P, but it did not in the NASDAQ. So I can tell you that if I force pin this 18-year cycle trough back here, and let's face it, that low in March of 2020, it was somewhat artificial. For one thing, it was not a full 18 months or anywhere really close to it past that low in December of 2018. I was looking for a typical 18-month cycle trough in about June of 2020, but they decided they were going to print $2.1 trillion and send it out to every mailbox in the US at this low. And this same kind of thing probably brought about a slightly earlier cycle trough low in March of 2009. But they didn't print near as much then. Back in, they started printing buku amounts of money, record level amounts back in November of 2008. And the market actually started to go up from that when they announced that, but it had one more low, which was essentially a fifth wave down from the 2007 high, October 2007 high at that time. But they didn't print this much. This is by far the most they'd ever printed. And the reason they thought they could do it is because they weren't seeing inflation. I have a good friend that does primarily, he's a money manager, manages many millions of dollars for wealthy individuals in my hometown. And he told me one time, he goes, they can continue to print these bear markets away until inflation catches fire, and then the printing party is over. They can't print in the face of big inflation, and that is what is different about what today and recent times. What's different about what the Fed and the Treasury, what's possible for them to do and what's not possible for them to do at this time. But at that moment, they felt like they could do it, and it bent the mirror. There's no question about it, and it probably caused an early trough here. And amazingly, in the NASDAQ, it did not make a new low in March of 2020, and in several important stocks below this low here. But anyway, when I do a Hurst analysis and force pin that large cycle trough back from the March of 2020 low to the December of 2018 low, that's where I'm getting these dates now, and I think they're more accurate than what I had been dealing with. So, any analysis, so for instance, an Elliott Wave count is good if it's the right count. It's terrible if it's not the right count. Hurst cycle analysis is no different. It's good if it has phased the troughs correctly, but it's not going to be any good if it hasn't been. So this is just part of what we deal with as what I deal with all the time as a market technician. I'm trying to figure out what all my tools are telling me and try to take a composite score of how it all works together. Ultimately, though, the Elliott Wave count, I think, in the internal subdivisions rule. So So that's the Dow. Hurst thinks there's a pullback down into probably early to mid-August next. You notice I'm using some manual phasing. I'm not counting necessarily on Hurst, on where the troughs are coming timed, the timing of the troughs. Like the purple line would be the 80-day cycle troughs. The orange line here would be the 20-week. And in Hurst cycle analysis, when you get an 80-day cycle trough, you might also get larger troughs at the same time, in this case, a 20-week, and the troughs typically coordinate and they happen at the same time. That is why bottoms in the market are typically spikes and tops are typically rounded. It constantly shows itself that way. So that's a really quick look at my Elliott Wave analysis on the Dow. Before I get much further, I want to change the order of what I typically show, and I want to show a few really interesting things going on in the markets right now. This is a Hurst cycle analysis of NVIDIA stock. NVIDIA. And you'll notice that in NVIDIA stock has been making its way to the upside very strongly recently, but the Hurst cycle analysis is projecting it is at or near an important peak, and it's going to be bearish next down into the middle of 2024. You might look at this orange line and go, well, that's not very bearish, Sid. Well, composite line does not, on Hurst, does not suggest price. It suggests direction. So while it leaves open the possibility that it could stay up, NVIDIA could stay up through approximately August 24, it's generally bearish until June of 2024. So I've been talking a lot in recent webinars about the poor breadth in the markets, where the market had continued higher while very few stocks were pulling it higher. And that going back, if you look back in time, there are a number of important peaks in the stock market where that was the case, where the market continued. For instance, 2007 was a perfect example. The market really continued to grind higher up through October 2007 on very poor breadth. And in other words, very few stocks were actually moving up. Most of the stocks were flat or already in a bear market when it made its high. But the stocks that were carrying it higher, because a lot of our indices are market cap weighted, were the largest market cap stocks out there. And so a perfect example today would be a stock like Apple. And we're going to look at a few individual stocks here in a minute. So what I want to show you is semiconductors. So on the semiconductor index, I'll show you the S&P in a minute. Hang out for the S&P, but I want to show you some really important clues about the market right now, without focusing just on the S&P. There's a tendency to want to focus just on the S&P, and there's lots of other clues around the market. One is, if you were going to, as an Elliottian, I assume that there's, how many in the room would consider themselves to be a decent Elliottian? Just throw something in the chats and just say me. Yeah, or I do. Anybody. You consider yourselves a pretty good, decent Elliottian. You've got a pretty strong understanding of Elliott Wave. Yeah. Okay. Yeah, quite a few. I figured there would be. So for those that understand Elliott Wave, how would you, if you were going to use one word to characterize the upward movement in the semiconductor index from the October low through the current high, what would it be? Yeah, chop. choppy. I think it's a good word. Brian says rising wedge. Lewis says corrective. That's the word I was looking for. Corrective. B wave. Double zigzag. These are all really great answers. Every one of the answers was really great. But it does. There's no wave 3 component to this move. Now, in my particular count, I'm counting this as an ABC, 3 waves down to the here. So that can either be a wave A or it could be a wave W. But just here in the last couple of weeks, the semiconductor index was able to retrace. You see that pink line right there? 90%. That's the 90% retrace of the move down from January through October of last year. So why is 90% important? Anybody? Anybody have any of you Elliottians out there have an understanding of why a 90% or greater retrace is important here? Yes, that is the minimum requirement of a wave B of a flat. There's the minimum requirement of wave B of a flat. So I think we've already established it's correct. It's a corrective move up, and so that is why I think anyone that thinks that the market is going to go ahead and shoot to the stars right now is probably wrong. Once again, I'm not calling names here. Anything is possible. I'm just going with the odds. But I think the chances are poor that this would continue strongly higher from here, because the price action, which really in Elliott Wave is the most important factor, is corrective. There's no wave 3 component here. And now we have this 90% retrace. So it's done everything it needs to do to complete a B wave. And that is why I used to put a label of A/W here and B/X, just in case it did not reach the 90% retrace. And so it has done the minimum that it needed to do. And so I could remove the W and the X, and what I would expect was the very next thing we would get would be a 5-wave down structure, probably to new low below the October lows. We're also seeing a divergence. You see this high in the RSI that occurred here. This last bit of upward movement that we've seen in the semiconductor index is not showing in the RSI. So we're seeing some divergence there. So I'm now, admittedly, a B wave of a flat can retrace wave A by 1.382. So yeah, there's more upside room. But why am I in such a big hurry to call it a peak here? And there's several reasons. Primarily sentiment, also a completed Elliott Wave structure, a completed double zigzag, and Hurst. So let's look at the NASDAQ. So does anybody think that this is high? This is as high as the NASDAQ is going to go ever? Does anybody think that? Before I get a reputation in the room of being a bear, so yeah, on the short term and possibly intermediate term, yeah, I'm a bear, but I do not think that the NASDAQ has gone as high as it's going to go. Just like I showed you earlier, I don't think the Dow Jones Industrial Average has gone as high as it's going to go either. Matter of fact, according to Hurst, we may not see the Dow Jones Industrial Average top for another couple of years. But on the short term, I'm bearish. So it's funny because everyone is so polarized today. When they see my work, they go, "Oh my God, you are a bear. You are a perma bear." Well, no, I'm not a perma bear. I'm looking for the finish to structures is all. And if the longer term you look, the more I'm a bull. But on the shorter term, yeah, I think we got to move down into the first quarter of next year. So check out this count on the NASDAQ. So this looks like a three-wave down into the 2002 low, and then a 1 and a 2. That's in November of 2008. And then a 1, 2, 3, 4, 5 for wave 3. That's up through September of 2018. A wave 4. Remember, in the NASDAQ, the plunge down into March of 2020 did not make a new low below the late 2018 low. So a wave 4 and then a 1, expanded flat for 2, 3. I just don't see any legitimate way to call this a 3, 4, 5 up into this high. And so I have never said that this was as high as the NASDAQ's going to go. But based on a number of factors, I'm suspecting it's moved up about as high as it can go right now for the time being, and therefore I'm suspecting that we're still in a wave 4. And then there's a wave 5. Yes, it's similar. Absolutely. It is similar. Yep, my charts aren't going to look like your charts. You should always look at these long-term charts in Simulog. Always. And so if this was the end of Black Wave 4, using my favorite Fibonacci target for the end of the 5th wave, I think the NASDAQ has a chance over the next couple of years of moving all the way up to 23,961. So just round it off, 24,000. So it's currently at 15.4. So that's quite a bit higher. But I think it needs to finish this wave 4. And if it moves slightly below the wave A and we get a flat here, and remember, I was just suggesting that the wave B on semiconductors had finished the double zigzag to the upside. The next thing we could see would be a plunge of 36% on the NASDAQ, approximately, down into the first quarter of next year. That would be your recession. After all these inversions, bond inversion, then you get a massive buying opportunity for the wave 5 of 5 on the NASDAQ. So no, I don't think the NASDAQ has topped. It just doesn't compute that way. So what's happening on this weekly chart? Well, it's not quite as obvious as a double zigzag on the NASDAQ, but when you look at the semiconductor index and you know that semiconductor index is highly correlated with NASDAQ, this is very likely a double zigzag. A, B, C for W, an X wave, and then an A, B, and then this blow off wave C. Overbought on the RSI on a weekly chart. Hurst thinks that the rest of this year is going to be down. The triangle is definitely still a possibility. That cannot be dismissed as a possibility. It's possible that the NASDAQ does not make a new low below the October low of last year. It could be a running flat, for instance. A wave, so I know a lot of people are talking about this rebalance coming on the NASDAQ, but what that's going to do, Dennis, I mean, isn't that going to remove some of the punch that the FANG stocks currently have over the NASDAQ? After all, it has been the FANG stocks that have kept, especially the NASDAQ, moving higher. It's very clear a phenomenon recently. So, yeah, I would say that the rebalance to where Apple and Amazon and Microsoft, et cetera, the mammoth 5 to 7 stocks that have been moving really the entire market, keeping it up and moving it higher, especially NASDAQ. If they take away some of their power, that's bearish, I think, on the market, most likely. But there's so many bearish signs right now anyway. Check out on the individual stock. Okay, and I'll show you. So that's a weekly chart. Here's a daily. This really scrubby start to this thing. A, B, C. I think it started with a 3-wave up structure, the NASDAQ out of the October low, and then 3 waves down for a B, and then a 5. So that completed a flat. So the first structure off of the October low, I think, was an Elliott Wave flat. And then we got an ABC for an X, and now an AB and a blow-off wave C. 1, 2, and 1, 2, 3, 4, 5 for 3, 4, and this needed to be a 1, 2, 3, 4, 5 to the upside. Now, going into the weekend, I was thinking that we still needed a little 3, 4, 5 up, but today's downward movement was strong enough that I've decided to call the peak. Small B area in your chart. Well, yeah, I could see. I've been looking at Apple stock specifically as kind of a rising wedge. Rising wedge really isn't an Elliott Wave term as such, but yeah, you bet. Yeah, that looks like a rising wedge. That's more of a term from the old, what was that book? It's an older technical book. The Edwards and McGee book, where they looked at patterns like cup and handled, rising wedge. And rising wedge is bearish. Once it breaks, you probably have aggressive turn. And but a rising wedge is a phenomenon. Some people want to call a rising wedge a diagonal, but it really, at least in the Frost and Prechter book, it's not officially a diagonal, because the 4th wave, many times in a rising wedge, does not come down and overlap the 1st wave. It's just a narrowing rise, and yeah, according to old line technical analysis, it is a pattern, and it once it ends, it's bearish. So that looks like a top is in. And here's something else I wanted to show you on the individual stock. Top is in for now, and Hurst is bearish down through the middle of September. Remember, the Hurst on this has been different all along than the Hurst on the S&P and S&P and Dow, because it puts a large cycle trough moniker on the late 2018 low. And then you move forward there. You have the first 18-month cycle trough, the second 18 months, and then the third one, and then you get another large cycle trough. Now, the fact that Hurst is calling this a 9-year cycle trough in the Dow indicates that, yeah, even though we've probably got some downward movement and a recession ahead, we might see that triangle where it does not make a new low below that low. That's certainly possible, but it's still bearish on the short term. And I want to show you a very important chart. It's the chart of NVIDIA. So NVIDIA has been one of the poster children of this most recent aggressive move up over the last few months in the stock market. And I want to show you an Elliott Wave count and the associated Fibonacci targets on NVIDIA. So this is a weekly chart. Here is the low in December of 2018. And then here's the count on the way up. 1, 2, 1, 2, 3, 4, 3, 4. And now NVIDIA has moved up enough in 5 waves. 1, 2, 3, 4, 5. That it tagged last week the points, the most common Fibonacci target for a 5th wave after an extended 3rd wave, which it certainly was. This 3rd wave was a 4.236 expansion of wave 1. So you measure this as a unit of 1, take it times 4.236 on a Similog chart, add it to the top of 1. You got this dotted line, no, this line right here. And that, is that right? Yeah. It was perfection. I know I made a big deal earlier about saying, no, there's no such thing as perfection, but that is about as perfect as you're going to get for the end of a 3rd wave. The subdivisions are even perfect. I will point out one thing to you right here. Look at this move up here. Does that look like a 5 to you? Does that price action right there look like a 5-wave structure? Okay, all you Elliott Wave experts in the room, the answer has to be no. It looks like an A, B, and then 1, 2, 3, 4, 5. This, just take this opportunity to say that wave 1s, in my experience, can many times, if you think the hanging out for a clean, clear 5-wave structure to determine whether you have a trend change or not, I can tell you there's been many, many times in history, lots and lots of times where that wave 1 does not give you a 5, a legitimate 5. And I've noticed that, and this is one of the reasons why I quit using Elliott Wave alone, and I started using other things like Hurst and correlations, et cetera, and sentiment, to boldly label something a wave 1 when it's not a clean and clear 5. I'm telling you, I've seen it happen a million times over the last decades, whatever decades I've been counting waves. Wave 1s are very often not clean 5s. So if you're hanging out, waiting for a clean 5, good luck. But sometimes you do get clean 5s. Like this looks more like a 5, probably a 1, 2, 3, 4, 5. Little 1, 2 down here, can't see it very good. Then 2, then 3, then 4, and 5. And now we have hit the best Fibonacci target for the top on NVIDIA. I saw a really good article from Lance Roberts a few weeks ago when NVIDIA was reaching, screaming higher, is probably right after this candle, talking about the fundamentals and the valuation on NVIDIA, that they would have to continue to grow exponentially, not just at the same rate, but exponentially for years, maybe decades, in order to ever get back to what is considered to be a somewhat normal P/E ratio. I don't agree with you, Simcha, on the dollar, and I'll explain that next. We'll go to the dollar next. Yeah, that's the normal correlation. The normal correlation may suggest what you're saying, but I wouldn't count on it. You know, we've seen that some correlations breaking lately, and I'll show you the dollar analysis. So anyway, it's hit the best Fibonacci target, and not only the best Fibonacci target for blue wave 5, but 1, 2, 3, 4, 5 in pink also had its target that was within an eyelash of the very same target. That little pink line, it was right there with it, somewhere around 470 something. So from a Elliott Wave and Fibonacci standpoint, NVIDIA may have topped. That's trouble for the NASDAQ, and it's trouble for the stock market. This has been one of the leaders, and the stock market could lose its leadership right now. But you have to admit, there's nothing wrong with this wave count. Everything looks, the only thing that's weird about it is this looked like a 5 in real time to the downside. But in hindsight, it had to be a triple zigzag. So that's trouble. So let's go on to the U.S. dollar. Oh, before we leave stocks, I'll just show you the S&P. I know some of you dial in for the S&P. I do think, I'll just give you my honest opinion. I think a lot of people zone in exclusively on the S&P, and I think that's a big mistake. I think you should make sure you're looking around at other clues instead of just having tunnel vision on the S&P, because sometimes these items are deceptive. So in the S&P, we've actually reached 2.9% higher than the high we saw in mid-June now. And we've reached, and you'll notice, and if you saw my recent webinar with the Elliott Wave Hub, I was talking about how the DSI had hit a 91. That's the daily sentiment index. The day before the peak in mid-June, there was 91% of all retail traders polled were bullish. And I went back in history, and I'll do that again for you here, and showed that back just prior to the January of 2022 all-time high, we got an extreme reading above 90 about 6 weeks or so prior to an extreme reading. The next highest reading was in the high 80s, almost identical to this. And then a couple days after that, few days after that, that was the peak of the S&P in January. I think it was on January 4 of 2022, and we'll look at that again in a second. So the sentiment is a huge reason why I'm super interested in calling at least an intermediate high peak at this time. And if you go back and listen, and I'm going to show you the sentiment screenshots. You go back and listen to my webinar that I did for the Elliott Wave Hub, and that was about a month ago. At that time, we were just right there in just past the high in mid-June, and we were getting a few days past that high. So actually on the ES contract, we're 2.56% above the peak on June 16th. Notice on my sentiment conditions, this is a proprietary chart template that I apply to every futures contract, and I make these available to premium plan members every night. You'll notice that, and so go back and look at my previous explanations of this, but commercials are short, heavily short the S&P on a 6-month look back as a percent of open interest. They're as short as they have been at any point in the last 6 months, and they are as bearish as they have been at any point in the last 12 months. So commercials are hedging. Retail traders, on the other hand, are still quite gleeful. They hit 91% of all retail traders at this large triangle here were heavily bullish. By the way, this daily sentiment index is a fairly expensive subscription that I pay for and can chart. And you'll notice that the most recent peak, we had an 88 on the DSI, even though the market was higher. So let's look back at the last time something like that happened. And the answer is it happened between November of 2021 and the all-time high on January 4. So on November 5 of 2021, we got a reading of 93 on the DSI. And then on this date, December 27 of 2021, we got an 88. And then 1, 2, 3, 4, 5, 6 calendar days or 6 trading days later, we got that top tick. Notice from the time that we got the 93 to the time we got the top tick in the markets, there was only 2.04%, basically 2% left of upside. This was what I was saying at the Elliott Wave Hub back in mid-June presentation, is that this may not mark the high that we're going to see for now, but it's a warning, and a good one, that there's precious little upside left in this market. So let's see what's going on here now. Well, we got a 91 here. That was on June 15. And then the top tick so far is July 19, so slightly more than 1 month later, we got this 88. And we're getting actually a clearer message from the commercials positioning that this could be about all we're going to see on the upside for now, right here on commercials positioning versus retail. So at major turns in the market, you'll notice commercials from this low back here, they were all green. They were building long positions. But then about here, mid-June, they started pulling back and building short positions against this trend. And they still haven't changed their mind at all. They've even become more strongly convinced, even though this has moved higher. That's the way commercials trade. They build positions against the trend. In other words, they're hedgers. They figured that if it gets too rich to the upside, they want to protect themselves against moving to the downside. If it gets too overblown to the downside, they move to fully long positions. And you see the DSI was down 15, 16 in here, and right in here on March 27, just a few days after the low, all conditions were perfect for go to the upside at that time, where commercials were all heavily long. Retail was just coming off some pretty low numbers. And that works really well most of the time. It worked beautifully down into the October lows of last year. Commercials were generally heavily long on the 6-month and 12-month look backs, and we're coming off of 5 and 9. You know, retail was so bearish going into that October low. They couldn't hardly, they were at record levels of bearishness, and that created a perfect storm of bullishness at that time. We have the exact opposite conditions right now. So I'm going to move on to the US dollar. A lot of course, the US dollar is extremely important. And we want to keep an eagle eye on what it's suggesting. And I'll start with the extremely long-term count the US dollar, or on the US dollar index, if it would be so kind as to change screens here. Here we go. Let's look at the long-term chart. Way back in 1985, the US dollar index was at 164 and some change. It was way up at this line here. My data doesn't even go back to 1985, the data I get from Trade Navigator. And it moved down in really aggressively, then put in triangle and one more leg down. That is a three-wave leg. To the downside, I've got that as wave one of an ending contracting diagonal. And then we moved up in three waves for wave two of the diagonal, down in three waves to wave three of the diagonal, and up in three waves for wave four of the diagonal. And need an A, B, C to the downside. And Hurst is bear as the US dollar pretty much for the rest of this decade. Now, you might look at this and go, wow, if the dollar is going to be that weak, then the stock market is going to soar. But I don't believe that's necessarily going to work that way, because at some point, the stock market is going to become completely concerned and worried about a super weak dollar. And they should be. And it should be. The US dollar has been the world reserve currency since Bretton Woods. And it's pretty likely that China will have the next world reserve currency, and that the US dollar will lose its world reserve currency status sometime during this decade, this decade that we're in. And and I think all bets are off on the stock market just reacting all gleefully to a weaker dollar. At some point, it's going to become a major concern, especially if it loses its reserve status, which it is almost certain to do, in my opinion, and in the opinion of some important economists. Shorter term US dollar index, very bearish recently. And I've got this as a wave one to the downside. It was clearly a five-wave structure, but I've got this as an ABC expanded flat, rather perfect, by the way, on its Fibonacci relationships of the waves. And that would mean that we would need a wave C to the upside next in order to complete an expanded flat for wave two. Now, when recently, and some of the people in the room here even emailed me about this. This was a major concern last week, is how aggressive the downward movement was in the US dollar. And I even had people suggesting, it's like, but this looks like a breakout and has wave three character to it. And I, because of Hurst, was expecting a 20-week cycle trough here and to move up into at least mid to late August. I was counting this as three waves up for wave A, three waves down for wave B. And by the way, I've got that as an ABC for a W, ABC for X, and then an ABC for Y. The US dollar index ended up bottoming It might be too early to be super duper confident in this bottom call here, but it certainly is looking good so far. And it's I had a target somewhere between 100.24 and 98.95, and it appears to have bottomed where wave B of the expanded flat was 1.236 times the length of wave A, and now bullish on the dollar. So this is bullish on the dollar up until somewhere probably late August. It depends on if you use the Hurst nest or the composite line, which I try to always, the nest would be like this would be a nest right here. It's kind of spread out. It would be an example of a nest. And the composite line, if you look at where it's projecting bottom, it's not in the center of that nest. So we got a nest bottoming, maybe this is on NVIDIA, maybe in November of 2024, but the composite line is saying that it might only go down until June of 2024. So there's it's never perfect, and so a lot of times you have a nest and you have the composite line with this, and so that creates a window. And I put that window on my charts. Also, a little concerning is, if you look at the timing of the 80-week cycle, so this is a 20-week cycle, an 80-day came in a little early, then the major trough on the US dollar index, that was the end of a 5-wave down structure down through early February of this year. Next 80-day cycle appears to have come in a little early, but it had kind of a bottoming process here, right in here. So could it possibly like slam down and go down to the 1.382? I would say maybe, but I kind of doubt it at this point. So I think the 20-week cycle trough is probably in. It doesn't have very much time to move down if it was going to move down to the 1.382 target. So it's probably its bottom. We're looking to the upside. And I was getting all kinds of email last week. It's like, man, Sid, you are going to be wrong. The dollar is collapsing now, and that's going to have ramifications throughout the market. And I was saying, no, I think it's just a B wave, and it was completely Hurst. So Hurst, for the most part, is a excellent companion during wave counting. Is it perfect? No. So if the dollar is going to climb until, let's say, late August, the dollar is going to climb all the way back to 107.88, which is my target. Yeah, the question might be, well, what's going to happen to gold? And that would mean that despite all of the avalanche of bullish talk about gold and silver that came in during last week, that we're actually going to see gold and silver moving strongly to the downside next. And you might say, well, wait a minute, Sid, the dollar, gold should go up. Gold should go up if the stock market is going down as a flight to safety. And I've got to tell you that almost never is the case. Gold almost never operates as a flight to safety. During strong downdrafts, especially in the stock market. I'll show you this. We'll look back at how gold reacted during the 2000 through 2007 through 9 stock market crash. So the orange line is gold, and the black line is the stock market. And the stock market was already very weak. Gold had also been very weak, but it had started climbing pretty aggressively right here into the Lehman collapse. When Lehman went under, that was on September 15th of 2008. the stock market in black continued to collapse even more aggressively, and so did gold. So if you're under the impression or the opinion that gold will protect you in the case of a stock market crash, please remember that that is not the last major stock market crash we had. That's not the way it worked. Now, once the Fed announced QE, that was on November of 2025, gold had already bottomed and started working its way up a little bit. And when they started printing, gold really recovered fast. So it may be more of a function of money supply and other things. But yes, as Prechter had mentioned often in his blue book and in his other writings, in a true bear market, there's no place to hide. So the question comes back: Am I Sid Norris calling for a true bear market in the stock market next? I'd be curious, how many of you would say that I am predicting a bear market in stocks? The answer is no, I'm not yet. But I do think, and I'll just go back to, so you can look one more time. I'm not really a bull or a bear. I can't be accused of being either one. On the and I saw the most interesting fellow interview, one of the more interesting ones, and I can't remember which investment bank he was with. It was yesterday, I think I saw him on CNBC. Is with one of the major investment banks, and he said this is a trader's market. In other words, he was singing my tune perfectly. He wasn't going to announce that he was a bull or a bear. He was basically saying that there's going to be times over the next few years where you're going to want to be short, and there's or hedged, and other times where you're going to want to be long, and that's what I'm saying. So, but I think the next significant move in the markets is going to be the downside. But here's this ending diagonal in the S&P. It started with an A, B, C. Wave C peaked at almost to the exact tick where wave C would be a 0.618 expansion of A. So what an expansion tool does on a Simulog chart is it expands wave A. And you can see, depending on, it all depends on how long the first 5-wave structure was to the upside. Then you very quickly, it doesn't matter if there's a deep wave B next or not, you have a couple targets. The most typical targets are where wave C would be a 0.382 expansion of A, but when you get a real shallow B like we got back here in 2000, October 2000, it's more likely that you would get a wave C that is a 0.618 expansion of A, and that pink dotted line is exactly where it went to. That is not a Fibonacci target for the end of a 5-wave structure. That's a Fibonacci target for the end of a zigzag. So and then in a diagonal, you often get a choppy overlapping complex wave 2, and it's typically rather deep. I've got 2 targets for it by the time we get into late in the first quarter, maybe early in the second quarter of next year. One is 3087 on the S&P, and the other one is 2865 approximately. And that is where wave Y would be either a 0.382 or 0.618 expansion of the initial leg to the downside. So it's a very same Fibonacci measurement tool that I used to, that it adhered to perfectly on this move to the upside. I thought I'd show you one other thing before we finish up, and then I answer questions. If there's anything specifically you'd like to see my wave count on, put it in the chat. I'll try to get to as many things as possible here for you within reason. I know we've been going for an hour and 45 minutes, so pretty long, but I try to be generous. Oh, we may see some symmetry on time on the S&P, according to Bob, where the initial move down was 40 weeks, and now we've seen 40 weeks of up. And that would be this week. That's interesting. The thing I wanted to show you was junk bonds. So this is an overlay of junk bonds. That's the candles. And then the S&P, which is in purple. And you'll notice that when the S&P, these two generally are correlated. When the junk bonds are moving up, the S&P is moving up. When junk bonds are moving down, like this is March of 2020, then the S&P is moving down. When the junk bonds are moving up, the S&P is moving up. Down was very highly correlated, then up correlated, down correlated, and the correlation stayed pretty tight until right about here. That was March 10. That was where the S&P bottom. This is a weekly chart. This is a line chart of the S&P, and the S&P went ballistic to the upside starting March 10. But what would junk bonds do? Well, it went up for a couple of weeks, and then it started grinding sideways. So this is an example of a period where items that are normally well correlated, they broke apart. And I think the conclusion you have to draw is that the move up in the stock market is manic market behavior that is not supported by junk bonds at all. So one of these items is they're bound to recorrelate. And I think they're going to correlate essentially now. There's a good chance that they would, for several reasons. I already talked to you about the nosebleed levels of sentiment right now. But I just did a Hurst a few days ago on HYG, and you can see this obvious triangle. And it's coming right to the apex of the triangle, or where the descending and ascending lines are coming together. And Hurst thinks that it's going to break to the downside, and then it's going to be bearish down into the first quarter of next year. Well, that's exactly what it thinks is going to happen on the stock market too. So I think they're going to recorrelate, and it's going to be bearish. So I'm going to go back on the requests here. Oil, GDX, XLE. I don't have a lot of confidence in oil right now. I think that oil has been manipulated by different political factions around the globe constantly. Of course, American politicians would that are in office would certainly want to see oil lower. That would raise their chances of being reelected, and so they have been pulling out all the stops. They've been pulling out all the stops. No, I don't have any hourly counts. Sorry, the more I do analysis, I get constantly asked, just like, can you get me an intraday? Can you get me an intraday chart on this? And believe me, I understand, because when I trade, of course, I start moving into lower and lower time frames and looking at 5s and 3s. However, I count a lot of things. I have hundreds and hundreds of charts, and I think that at least I have a much better chance of generally being correct on the daily charts. And I think when you start getting intraday, things start getting very noisy, and if you're trading on too large of a position in relation to the size of your account, then you are begging to be stopped out with pure noise. My recommendation would be trade smaller and try to hang on to and always be aware of what's happening on the weekly and daily charts, on the analysis, and that might allow you to become a lot more patient. The Hurst analysis should allow you to become more patient generally. As I mentioned before, it's not perfect. Nothing is. Nobody's Elliott Wave count is perfect all the time. People change Elliott Waves like underpants. So crude oil has been working its way higher, and I did call for this, for crude oil to work its way higher. But and really, Hurst hasn't really changed his mind much. I had one fellow that subscribed for a little while, for 1 month recently, and crude oil moved sideways during the month that he was subscribing. And Hurst was claiming that this was an 18-month cycle trough, and still is, and it should be rather bullish out of an 18-month cycle trough. Well, it hasn't made any new lows, but yeah, it put in a basing, what I would call an unobtrusive basing, choppy basing, and now it seems to be breaking out to the upside. Hurst thinks that crude oil is going to move up through August 15. Now, I know when I see that, and I also expect the dollar to strengthen through late August, it makes me wonder what the heck is going on. And I can tell you, of all of the commodities, crude oil is the least likely to move opposite the US dollar. Gold and silver are the most likely to move opposite gold and silver. So this is bullish, but only for a few short weeks into mid-August, and at that time, a very large cycle, 18-month cycle trough. And longer term, looking for downward movement on crude oil all the way through late next year. But here's, I want to give, before we move on, I want to give you an example. And this is something that happened to me, is that during this downdraft right here on crude oil, it was so noisy. There's no wave 3 of 3 component in the middle of that decline. It just chopped. It's like every time it wanted to rally, there was somebody, a master up there, monkey hammering it down, and that is the kind of thing I'm talking about. How if you get too short term on things, you can get, I don't know how anyone could have traded this and stayed short all the way down. But in hindsight, I just simply had to call it a wave 3. I have no idea how the internal wave structure. And when I see something like that and it doesn't look right to me, I just stay away from it. Something's going on with the price action that doesn't fit into my world. of Elliott Wave, and so I just look for something else. But anyway, in the short term, it's rallying. I think it probably, according to Hurst, is going to rally on possibly up to about 92 a barrel over the next 3 to 4 weeks. GDX and XLE are the next requests. Yeah, I have an actual chart where I've left the, I've kind of moved away from the oil grouping, but I have a crude oil chart that shows different releases of the strategic reserve, and it's pretty clear that that did affect the price of oil. And at the same time, Saudi Arabia has been trying to prop up the price of crude oil. So there's been this warring faction, and I think I can see it on the charts with all the noise. So here's GDX. I'll have to say on GDX, the next movement I expect is on GDX is down generally. And notice it was down today, and the stock market was down today except for the Dow. And I think that's telling. And so what I've done on GDX is I show you a roadmap that's based on Hurst, but I also show you that the US dollar is pretty bearish. I'm sorry, pretty bullish until at least mid-August, possibly on into September. So it's possible that we have a top here. I think there's a pretty good chance. Matter of fact, I think I'm going to label it that way. And I just don't think these stocks are going to do well until as long as the dollar is moving higher. And I think the dollar moves higher through at least mid-August and possibly on into September, in which case we get a bounce. I fully expect to have to revise this count because if the US dollar does what I think is possible, and it starts really plunging from that mid-August projected low, we could see the dollar much stronger. I'm sorry, GDX much stronger than that. And if you'll notice, my wave count is, if you look at it as a whole, it is bullish. So just to show you the big picture. From this low, wave 1, and then a deep wave 2, and then a 1, and then an expanded flat underway for wave 2. Now, Hurst thinks it's not going to bottom. These stocks aren't going to bottom until around April. Well, that's pretty much exactly what I think is going to happen with the stock market. So it very well could be that GDX, the gold stocks, are going to get punished right along with the stock market all the way into the first, possibly second quarter of next year, and that they will not be the way my roadmap currently is suggesting that they would not necessarily be available as a flight to safety item. We'll see. But as long as the dollar, I'm bullish on the dollar until mid-August, possibly mid-September, I expect that these will likely go down, these stocks. Let's look real quick at gold sentiment. So this is a comparison of the commercials versus retail traders on gold. And you'll notice that, and also these brown stripes here, this brown stripe, means that the ADX indicator is over 60 on a daily chart, and that often predicts that the trend is currently overextended. So it was overextended here and it rallied. It was overextended to the downside here and it rallied. But commercials as a percent of open interest actually predicted this rise. But they also, because the commercials on a 6-month look back and a 12-month look back are still, for the most part, heavily bearish, this prediction here was that it would bounce, but that's all it would do. And then you would get bearishness. So I'm bearish on gold, bearish on silver, until the dollar recovers up through at least mid-August. Newmont, yeah, I haven't changed these charts from the weekend. I was boldly calling for Newmont to move down into probably August next while the dollar climbed. And today, yeah, it's down. My thoughts on Walmart is that it's not good. I keep count on Walmart and it's bearish. So I'm asking for, we also ask for silver and Bitcoin and XLE. So on crude oil, it's been moving up recently. I haven't even looked at my XLE chart since I did the weekend webinar on Sunday. Let's see what it says. Okay, Hurst was predicting that XLE stocks would go down through mid-August next, then climb through October 3, then bearish for pretty much all of next year. So I don't know. That's really just based on Hurst. And on the short term, it looks like they're holding up well, but I expect them to move down for the next approximately 3 weeks, 4 weeks possible, and probably with the rest of the stock market. Bitcoin. Before I jump to Bitcoin, I'll just let the cat out of the bag. I'm bearish on Bitcoin all the way into the first quarter of next year. I think my best recommendation to you, based on Hurst cycles analysis and based on my associated wave count, is to dump Bitcoin now. So you can see, I think it's going to work its way lower into the next 18-month cycle trough nest, which is due in about April next year. And yes, I know that it made a 5-wave up structure off this low. 1, 2, 3, 4, 5. But then it started working its way lower. I've got it as an ABC for W, ABC for X, ABC for Y. That would be wave A, and then an A, B, C expanded flat to a slight new high from over here. But I think it just, as far as I can tell, Bitcoin is not going to be the place to be. That's why I say, why bother subscribing to my $25 per month plan if, especially if you're in Coinbase, where all you can do is buy Bitcoin. You can't short it. If you want, I think it'd be much more interesting to look at the shorting it using futures, the MBT, micro Bitcoin futures contract. Yeah, so I'm, this is what you look at this. This is strictly momentum signals. So momentum signals, the way they work is they figure that the trend is still up, and they'll continue to figure that the trend is still up until this green line right here flattens out and starts to slope to the downside. It looks like it's really close. But the way momentum algos work is they determine what the longer term trend direction is, and then they trade only in that direction. And once in a while, they'll pick up a big winner. Like this big green block here, that's a winner. Here's a big winner. But this is what happens with momentum algos is during sideways, choppy, noisy price action, these little red boxes here, these are all losers. It gives back a lot of profits during sideways choppiness. And then it needs a trend, but once it gets it, my algo is designed to capture as much of a strong up move or a strong down move as it can. For instance, back here, like it captured an enormous winner. This huge green box means it got short here and then it took profit here. That's an enormous winner on a short on Bitcoin. And then it consolidated, gave up some of that and gave some, but then as it started moving down some more, it got a couple of winners. Got a nice winner here on a short. Then it moves sideways for a while. And look, it's got the red boxes. So what the algo does, it's momentum algos are really quite dumb. They establish the longer term direction. They assume that every time there's enough movement in the direction of the longer term trend, they will attempt to get long, hoping that that's a breakout move. Well, only about 1 in 3 are breakout moves. But when you do get a breakout move, they win big, and that keeps them, bringing in profits over the long haul, and as long as they don't have to give back too much on the pullback. So this is our current spreadsheet that we're going to supply at the website. When we put the recording in this webinar up, this is a sortable Excel spreadsheet that you will be able to download, and you will be able to use these sorting categories. So there's a number of ways to measure which of the algos are doing the best. Your 3-year return on gain is probably your best category to click on. And you can see that the euro and gold are leading the pack. It makes sense that those would lead the pack as they are highly correlated, which means that they have a tendency, when they swing, they will trend. So they will trend long enough to catch a nice winner. And then you can look when you're sorting on the spreadsheet, you can also look at the number of consecutive wins and the number of consecutive losses. And you would see here that trading the euro over the last 3 years had the current settings based on back testing that we just did. Had they been in place the last 3 years, it would have brought in a 418% return on gain during that 3-year period. The account size required was very small, $6,611, and that trades one G6E contract at a time. Amazingly, there was about the same number of winners and losers, 30 winners and 28 losers. But the most consecutive losses during that period you would have had to sit through is 3. Now, something you need to realize about back testing and automated trade signals and momentum signals is there's a number of assumptions that are made. The assumption is that had the current optimized settings been in place for the last 3 years, that would have been the return. However, And we'll get you this spreadsheet. I'll make it available at the site. Let me go to the Euro page and show you that exact algo, and you see how it did that. This is for premium plan subscribers. So here's the AMA algo, and we call it the AMA algo. So the big green boxes are winning trades, theoretical winning trades. The small red boxes are losing trades. And you might ask, well, why is it that the red boxes are smaller, much smaller than some of these green boxes? And the reason is because it uses a protective stop. So it uses in this case, a fixed stop of $2,000. And at some point, if there's a little bit of loss of momentum detected and you get one of these red arrows or one of these little bitty green arrows and you're in a trade, that suggests changing to a trailing stop. And it suggests using the $1,450 trading stop. Over the last 3 years, 30 winners and 28 losers. The average winner, $1,589. The average loser, $715. So this is something that my algo does. It is a true momentum algo. It doesn't go for winning percentage. It goes for it hits for power. It's looking for home runs. And when it gets one, it sticks with the trade until there's a lack of momentum is detected, and then it takes profit. But that allows for some pretty big winners. All these green blocks are winning theoretical winning trades. Had the current settings that I just did a back test on early first half of July here, and set the indicators on this. And so it works. One thing I will say, and it tends to work pretty well from back test to back test continually. But I will say this, in recent times, the markets have been noisier and larger and larger stops have been required for the entire 3-4 years that I've been publishing the algos. Each time I do new back tests, they're requiring larger and larger stops. And this, to me, is the value of combining my general work on combining Hurst and Elliott Wave and coming up with a solid idea on whether to be bearish or bullish and for how long. And I think it's if you can build up enough confidence that these roadmaps are correct, you would be able to stick with trades longer and not necessarily get stopped out on some of these moves. So this is, I think that's it for tonight. That's all I'm going to cover. Look for dollar strength, in my opinion, to continue through at least mid-August, possibly on into September a bit, and that should have negative ramifications over the next several weeks on the stock market and on metals. If you've never subscribed before to any of my plans, send me an email. I'm going to show you my email address here. It's very easy. It's sid@elliottwaveplus.com. And just let me know, hey, I'm interested in maybe your basic plan or your pro plan. Can you get me half price on the first month? And I'd be happy to if you've never subscribed before, and I'll refund 50% right back to you. Thanks so much for hanging out with me tonight. It's been a long one. Please consider a subscription, and be careful out there. We may be at a very important juncture in the markets. Have a great one. See you later. Bye-bye.